Okay, gang, in today's video, we're tackling that fickle monster that is credit cards and credit card interest. So first, let's get the basics of credit down. Credit refers generally to the ability for someone, like you or me, to obtain a good or service before we've actually paid for that good or service. And this is based on a system of trust, where we assume that the person is going to pay for that thing, whatever it is, at some later date. By the way, in the US, credit scores are one way that we establish that trust. So obviously that works out when you want or need something that you might not have the funds on hand to pay for it. And there are different forms of credit: car loans, personal loans, mortgages, which are just loans to buy a home, lines of credit, which is a special kind of loan that some banks offer, and of course the thing we're here to talk about today, credit cards. Now, a credit card is just credit issued by a bank, typically in the form of a small plastic card that allows us to buy things. And every credit card has a limit, sometimes also called a credit line, that basically spells out how much we're able to spend on credit before we need to pay it back. So a credit card with a $5,000 limit will allow you to buy any number of things, totaling up to $5,000. Now, in an ideal world, when you use a credit card to buy things, you're never spending more in a month than what you have to pay in your checking account. But let's say you spend $2,000 on one of your credit cards, and you only have $500 to pay to the bank when the bill comes due. That's where interest comes in. So if you think of credit as a loan from the bank, think of interest as the cost to us for borrowing that money. It's basically a fee that gets tacked on top of whatever you owe. And the interest amount you ultimately pay is going to be based on three things: the rate that the bank itself decides to charge, which is known as the APR or annual percentage rate, the amount of time that your credit card balance is unpaid, and the amount of the balance that's owed. We'll get into the math behind the APR in a separate video because it isn't quite intuitive. But for now, just know that the APR is the bank's way of saying, hey, we'll let you spend up to this amount on credit, but if you don't pay us back the balance of what you use, we're going to charge you X on top of that balance. Now, this point may be obvious, but it's worth spelling out. Why exactly do credit cards work this way? Because interest is one major way that banks make money from credit cards. If you're having trouble visualizing, think about it this way. The bank is giving you $5,000 that it already has in the form of credit, right? You spend $2,000. When you eventually pay that $2,000 back, the bank isn't profiting from that exchange because they're basically just getting back what they gave you. But if you leave any part of that $2,000 unpaid for 1 month, 2 months, 10 months, maybe 50, it's the interest that accrues during that time that registers a profit for the bank, assuming, of course, that you eventually pay back your full credit card debt. And if you also happen to make any payments late, banks will also make money from late fees. So that snowball effect that I've just described of money owed is where people can easily fall into credit card debt. Because if you're using more of your credit allowance than you actually have to pay back, then you inevitably can't make the payments required in order to not accrue interest. Then for the next bill, not only are you on the hook for whatever you didn't pay the last time plus any new purchases, but you're now on the hook for the extra interest that's accrued on that amount that you didn't get the chance to pay back. And if you can't make a large enough payment that second month, then what happens? You're on the hook for even more money the following month because your outstanding statement balance from the last time is higher, and so you've accrued even more in interest. So when you hear people say that they're in thousands or even tens of thousands in credit card debt, this is the physics behind how that happens. And it can easily snowball further if you have large purchases or many, and you're not focused each month on trying to pay down your balance. So when you're using credit cards, the best way to avoid paying unnecessary interest is to pay your statement balance in full. That means not spending more than what you have in your checkings account. And if you do have credit card debt already, the main way to pay your way out of it is to make monthly payments that are larger than the minimum. The higher the payments you make, and the more consistently you do so, the faster you'll get out of debt. And if you're able to figure out the math, you can set targets for when you expect to be able to remove those debts. But If your credit card debt is significant enough and your debts go beyond a single credit card, then know that you do have options to consider around prioritizing your debts, consolidating or balance transfers, negotiating with creditors, and even enlisting professional help to suss all of this out. And finally, gang, if there's one thing you should absolutely take away from this video, do make sure that you make those minimum monthly payments in order to at least avoid bank late fees, because that's an easier way to keep a few dollars in our pockets. And that's how credit cards work. If this video was helpful, please give it a thumbs up. And for even more tips, be sure to subscribe. Thanks.